Hey, thanks for listening to Your Money, Your Wealth. For a free gift from Joe Anderson CFP and Big Al Clopine CPA, visit yourmoneyyourwealth.com and hit the special offer button to download our key financial data guide for 2018. This handy guide contains useful information about taxes, retirement account contributions, Social Security, Medicare, can't miss deadlines, and more to help you organize, plan, and save in 2018. Download your free Thanks for Listening gift. Click on special offer at yourmoneyyourwealth.com.
I discovered personal finance blogs online, and I started following those folks, and I found my financial life really improving. And then eventually I said, I've consumed enough, consumer to creator. I need to kind of share my ideas with the world too, and maybe use this as a tool for myself to become accountable. So I started a blog in 2007 and called it PT Money. We paid off all of our debts other than our mortgage, and we had really aggressively saved for both our emergency fund and for our retirement. The rest is history. I've been blogging full time since that point.
That's Philip Taylor, aka PT of PTmoney.com. Today on Your Money, Your Wealth, PT shares the method he used to reach financial independence, transitioning from certified public accountant to a financial media mogul in just a few short years. Plus, 5 ways to turn retirement savings into income, how a big lottery win might affect your Social Security benefits, and if you dollar cost average into Bitcoin to buy winter parkas, how is that actually taxed? To examine this ridiculous question, here are Joe Anderson CFP and Big Al Clopine CPA.
There's Bitcoin, Alan.
Yeah, a lot of people have Bitcoin now, and they're wondering how it's taxed.
Right, and I think there's a ton of confusion on how Bitcoin is actually taxed.
A ton of confusion, and I guess the answer is it depends. But in general, Joe, Bitcoin is taxed just like stocks are. So in other words, if you buy Bitcoin for $1,000 and you sell it for $2,000 and you've held it for at least a year, then it's long-term capital gain. So in other words, then you've sold it, you got $2,000, you invested $1,000, you have $1,000 gain, so you pay capital gains on $1,000. If it's short-term, then if I did the same thing, but I bought it 3 months ago and sold it, now it's short-term capital gain, which is taxed at ordinary income rates, which obviously are the higher rates. And I think that's pretty easy to understand. But here's where it gets tricky, Joe, is when you have Bitcoin and you use Bitcoin to buy goods and services,
right.
Every single time you use Bitcoins, it's a taxable transaction. So in other words, I have $1,000 I bought in Bitcoins. It's now worth $2,000. And lo and behold, I found a really cool jacket that I wanted to get, parka for winter, right? Because it's so cold in San Diego, right? And so the retailer.
So that's why you got Bitcoin, just to load up so you can buy parkas.
Retailer accepts. That's the only one I could find, a parka salesman. So they accept Bitcoins. So I say, all right, here's $500 worth of Bitcoins. Cool.
It's a nice parka.
Really nice. It's just tricked out. It's got zippers and latches, and I can carry stuff on it. Anyway, so when I did that, I created a taxable transaction, and I think you can sort of see where this is going, right? So if my Bitcoin went up, basically doubled. Okay,
so that $500 parka didn't cost you $500.
That's right.
It cost you $500 plus the taxes on the gain of that. It depends on if it's short term or long term. It's going to be ordinary income on that gain to buy the parka, right. Or it's going to be capital gains.
So the gain on that parka, by the way, would be $250. So I got to show that as a capital gain transaction on my tax return. And like you just said, if I've held the Bitcoin for at least a year, then it's long-term. If I haven't, it's short-term. If I'm adding and subtracting from Bitcoin all the time, that's where it gets really confusing.
So the blockchain is tracking all that.
Supposedly. Right now, there's no reporting to the IRS, but that doesn't mean that you should ignore it, because the IRS actually does have task forces that are trying to figure all this out. But a lot of people then, they say, okay, I want to do it right. What do I do? Well, you use Form 8949, which is it's kind of the detail page for the capital gain, Schedule D. So that's where it goes, and it either goes in the short term or the long term. And when you use those forms, you have 3 different choices to make. One is that the IRS knows about this, that what you sold it for and what you paid for it. Well, that's not going to apply. The other box is the IRS knows what you sold it for, but they don't know what you paid for it. And that doesn't apply. The third one is IRS doesn't know anything about this, and that's the one you check. It goes on 8949, whether it's short-term or long-term, depends on how long you've held it, and then that will go forward to your Schedule D, and you'll pay capital gains tax on that.
Yeah, well, I don't know. Good luck with that, I suppose.
If you're using it to buy goods and services, you're going to have a complicated tax return.
Right.
Yeah, I'm just telling you.
Yeah. So the parka you bought, you got to pay tax on it, and you got to pay $10,000 to get your tax return done.
That's exactly
right.
And then I had to pay sales tax on the parka because it was in California, and then I had to get some more Bitcoin. Then I had some more gain.
Right.
And then they.
But it works in reverse too. You could harvest losses.
You could harvest losses. Now you couldn't buy the Bitcoin back for 30 days, right? You could buy another currency, digital currency, I suppose, if you wanted to.
How about if I'm dollar cost averaging into Bitcoin?
Yeah,
and then I'm using Bitcoin to purchase goods and services, and then I took it at a loss. So do I have to stop buying Bitcoin? Because it's the 30-day wash rule?
That's an excellent question.
You know what I mean?
And these things haven't been figured out yet.
Right. Yeah. Because, hey, I'm putting in...
you put out of your paycheck.
Right. I want to buy $500 worth of Bitcoin monthly.
Right. So you've got... I suspect that's what's going to happen. I think ultimately, Joe, there's going to be some kind of tracking system. It's going to have to be average cost. It's going to get too confusing otherwise.
Okay, Big Al, but what about those of us who are still confused about Bitcoin and blockchain in general, let alone the taxation of cryptocurrencies? If you fall into that category, go to yourmoneyyourwealth.com, hit that search at the top of the page, and type in Bitcoin. You can revisit Joe and Big Al's interview with Amanda B. Johnson, a cryptocurrency expert who laid it all out in very simple terms. If you don't have time to listen, you can just scan the transcript right there in the show notes. There's also a Crypto for Beginners Q&A and a video about whether or not Bitcoin is real money. Check it out at yourmoneyyourwealth.com.
It's that time of the show where we bring in someone that's a lot smarter than us, more talented, and has a lot more experience. So we have Philip Taylor. I'm really excited to have PT on from PT Money. He's done so much for the podcast community, and it's our real big treat to have him on. PT, welcome to the show, my friend.
Thanks for having me. This is an honor.
Hey, well, I would like to talk a little bit about your background. You're a CPA by training, and then you decided to not do taxes anymore and get in to be a media mogul. So walk me through your career path here.
Sure. Yeah. I went to school to be an accountant, just like my father. My dad's a CPA, but my mom was a teacher and a writer. Little did I know I would bring that talent into my life at some point. But I went through the traditional path, accounting school, wanted to follow my dad's footsteps, get a CPA. I thought that was a safe track, a safe plan for me. Did some public accounting and did some corporate accounting as well. So I did some taxes, auditing, and found myself in internal audit. It's spent about 10 years doing that. Was semi-satisfied with that work. Certainly enjoyed the lifestyle it afforded me. But one thing I noticed along the way was that my knowledge of taxes and auditing and corporate finance wasn't necessarily propelling my personal finances. And I really needed to kind of take it upon myself to discover how to improve those things. So I found myself a little bit in debt, had problem really saving money and accumulating money for emergencies or for those big, like a house down payment, things like that. So I was like, man, why am I still struggling with this? I'm supposed to be the guy that's got it figured out. And I started doing some research. I discovered Dave Ramsey, of course. A lot of people credit him with kind of helping them figure things out. And then I discovered personal finance blogs online. So there were these people online sharing their story of how they were getting out of debt or how they were improving their financial life. And I was really attracted to these real people sharing these real stories, albeit sometimes anonymously, so they could get away with kind of sharing the details. But that was very attractive to me, and I started following those folks, and I found my financial life really improving. And then eventually, I said, I've consumed enough, consumer to creator, right? I need to kind of share my ideas with the world too, and and maybe use this as a tool for myself to become accountable. So I started a blog in 2007 just as kind of a hobby on the side while I was doing my corporate gig, and called it PT Money, and just started talking about money from my perspective. I think my first article was comparing watching a UFC fight, the Ultimate Fighter Championship fights every other Saturday or so. I compared going to Hooters to watch it or staying at home and watching it on pay-per-view. And so that's kind of where my mind was, how geeky I was about money at the time. Like, am I going to save money by going to Hooters or watching at home? And maybe inviting a friend over. So that kind of kicked it off for me, and I shared more on the blog through the years. But it's been a real life changer, to have discovered that medium, blogging, and then podcasting eventually, and just to kind of be in this little budding industry.
So, what were some of the lessons, I guess, in the beginning that you learned? Is that, all right, you're a CPA, you're a real smart guy. You were in corporate finance, CPA for 10 years. So when it comes to financial acumen, you were probably ahead of most, but you were still struggling, right? It's like, hey, you know what? How do I continue to accumulate? So you start reading blogs. What was the turning point? So it was like, okay, now I'm having a little bit of fun with this, but what was the turning point for you to say, you know what? These are some lessons that I learned to really change my financial life.
Yeah, the turning point was actually seeing what other people who were having success were actually doing, right? Oftentimes money is still a taboo, and you guys are talking about it on your show, but it's not often talked about amongst family members or friends and the real details, right? And so I still had debt in my life, and I was struggling with living beyond my means a little bit. Even though my income was going up, I was still, had some car payments, had some student loan debt that was sticking around. And I just felt like I was living sort of on the edge with my finances, and I was not progressing at a rate that I saw these other folks who were sharing their details online were progressing. So in a way, it was like throwing down the gauntlet on me. Like, this is what they're doing to move forward. Why can't they're just like a regular Joe, just like me. I could put myself in that same situation and move toward financial independence a lot faster. And so getting really hyper aggressive about getting debt out of my life and getting out of the idea of borrowing from the future to pay for today's expenses, whatever it is, and getting the debt out of my life and moving forward to a place where, I wouldn't necessarily have to finance everything in my life, and then also that I was being aggressive with my savings. So, we're taught sort of 5-10% was sort of like the high water mark oftentimes for folks, what the industry kind of preaches, and these folks were really aggressive or really radical with their messages of 20, 30, 40, 50%, savings rates, so that you could move toward financial independence much faster. And that hit me at a time where I was in the corporate world and somewhat enjoying my work, but really just kind of searching for that next thing and realizing that I was kind of stuck in my cubicle in a way. And I wanted more freedom in my life, more independence. And so I saw finances as a way to kind of escape sort of the path that I had created for myself through college and career, and then this debt, and so those were kind of the key moments, and searching for that freedom and wanting to kind of become an independent person was probably the biggest catalyst for me.
It's funny. It's what I think the really good blogs out there can really help motivate an individual in such a different way than a financial advisor could, right? So if you've ever listened to our show, and I hope you never do because it's really boring and it's awful, but right, we talk about Roth IRAs, who can contribute, what's the tax code, blah, 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 right? So we give a lot of facts. And then so some people really enjoy that. All right, well, here, I really didn't know that I could do a Roth IRA conversion, for instance, okay? Or, what is tax loss harvesting, and any other example that I can throw out there. So you listen to that tidbit, and then sometimes people will take that information and try to build an overall financial plan. And at the end of the day, it kind of looks like Frankenstein, right? It's they're doing things that they probably shouldn't do. But at the end of the day, I think what people are lacking is the motivation to continue to save and probably to pay down debt and really have a true vision of what their financial life should be. Mm-hmm. Because a lot of individuals that come into the office, after they give us all their information, a lot of questions, they'll say, well, what do you think? Comparatively to someone else, are we in good shape, bad shape? Because I think in the back of the mind, everyone wants to know they're going to be okay. But if I read these blogs and I can compare in my living room or my bedroom or wherever I'm reading these, it's like, man, this person's saving 40% of their income. They have $1 million saved and they're 30 years old, right? Or whatever. And then it's like, then that can help potentially motivate someone a little bit more. And it sounds like that happened to you.
Yeah, absolutely. I started to, they say you're the equivalent of the people you surround yourself with, right? And so I really started surrounding myself mentally with these online characters who were a lot farther ahead of me. And I didn't buck against that. I saw myself moving toward that. So I wanted to aspire to what those folks had put out there for me. And so that was kind of part of it,
We've certainly surrounded ourselves with quite a collection of characters here on Your Money, Your Wealth. We've talked to folks who have reached financial independence through rental real estate, through blogging, starting side hustles, even some pretty creative gigs like flipping VW camper vans and cat sitting. Listen to these inspiring stories or read the transcripts at yourmoneyyourwealth.com. Subscribe to the podcast, get our podcast newsletter, and take advantage of a huge learning center full of personal finance articles, white papers, webinars, and hundreds of video clips and full episodes of the Your Money, Your Wealth TV show. It's all at yourmoneyyourwealth.com.
So then you started blogging a little bit. And then when did you make the switch? You're like, all right, well, here, I'm going to be a professional or get paid to blog. And I mean, that's a leap of faith from someone that's... Well, I don't blame you, because I got buddies that are in corporate audit, and I mean, they're either alcoholics or they're almost on the side of suicide. Right? That 10 years, man, that's you need a trophy.
Yeah.
That's
yeah,
pretty
it
hard
was a
work.
grind. It was a grind at times. When I started doing it, I started just on the nights and weekends, and I became really obsessed about the topic of personal finance and just sharing sort of my little ideas and tips and tricks for others. And then once you get into the community and the process of creating, just sort of creates this habit of repetition, and you just sort of get into the groove, and you start getting feedback from listeners, readers, followers. Hey, this is helping, or hey, what about this idea? And you just sort of get into the groove, as you do with your show, I'm sure. And so somewhere along the way, I turned on ads on my site, right? So I think it was about 8 months into my journey, I turned ads on, and then a couple months later, I got a check in the mail. And I was like, cool, this is like Google sending me $100, for doing this website. And I discovered, I could actually turn this into something that would create a side hustle for me. And so that was my initial goal, was just, hey, maybe it would be cool if one day this paid my mortgage, right? And so I started paying attention to what other bloggers were doing out there to monetize their sites. Eventually found myself at a point to where I'd replaced about, a third to a half of my corporate salary.
Wow.
And during those 3 years as well, from 2007 to 2010, we paid off all of our debts other than our mortgage. And we had really aggressively saved for both our emergency fund and for our retirement. And so I was by no means financially independent at that point. I think I was around 30, 31, 32. But I decided that I had enough on-ramp. And so it was 2010. I was faced with another big trip through my corporate gig, and it was going to be over my daughter's first birthday. And my wife said, hey, if you want to go out and do your own business thing right now with the blog, this would be a good time to do it so you can stay home for the birthday. So I was like, yes, that's my excuse, I was a little nervous about making the leap, obviously. Health insurance at the time wasn't figured out, and so it was a concern for me, but we did it, and we had enough on-ramp, and I'm a CPA, and so I always kind of felt like I could fall back on that at a minimum if I needed to. But the rest is history. I've been blogging full-time since that point, and then started the conference a year later because I needed another side hustle. So.
Right. So now you're transitioning a little bit. Is that all right? Well, before it was just personal finance, and then you were blogging to help other individuals, find financial freedom. But then you started a movement, if you will, in the podcasting world, especially in regards to personal finance. So you started FinCon. Tell me a little bit about that.
Yeah, so as part of my journey of making the blog successful, it really relied on me talking to the other creators around me. And they gave me so many ideas. Hey, you need to be writing on this kind of stuff, or make the post look like this, or you work with this advertiser. And so through those conversations, that discussion on a daily, weekly basis, my efforts just got so much better. And so I was like, I got to meet more of these people. I've got to be face to face. These are my new friends, my new colleagues. We need to get together for a meetup, So we started meeting up around the country at different places, other conferences. And then ultimately one day I just said, it's time. We need to have our own event. There needs to be a personal finance blogger conference, and it's very limited in scope initially, the idea. So I just invited, 10 or 15 of my blogging friends, thinking maybe, 50, 100 ultimately would show up. Ended up having 250 people across all the mediums. So we had podcasters there, traditional radio there, people doing video, bloggers, traditional journalist outlets, things like that. It was really just a kind of a celebration of sort of online digital personal finance information. So we quickly changed it to FinCon. And then, I didn't know what I was doing from an event perspective necessarily. I didn't have that background. So I enlisted a friend from college who had a little bit of skills in that area, and she and I built out the conference and been running it ever since.
Who were some of your early influencers? So, that first group of great podcasters or financial bloggers, who are some of those individuals?
Yep. So J.D. Roth from Get Rich Slowly comes to mind. He was probably one of the biggest, most successful early financial bloggers out there. And he was our opening keynote at the event. I think it was fitting that people kind of considered him the grandfather of the industry. And so to have him there was great. Paula Pant was there, who has a fantastic podcast called Afford Anything. She does a great show. Who else was there? The podcast Answer Man. Cliff Ravenscraft was there. Even though he's not specific personal finance, I wanted to rely on someone who was really into the podcast world, who could come and teach us and help us. He was there. And then, of course, Pat Flynn, who's big at Smart Passive Income in your town of San Diego, does a really good job. He keynoted for us that year. And then Ramit Sethi from I Will Teach You to Be Rich was there as well. So we had a rock star lineup. It was really cool that these folks supported the event, came out, and it really came together as a community. And I think that speaks to the topic we talk about. Like, we're the weird people online talking about money, right? And having this conversation. And so when we get together, it creates this real bond and collaborative spirit to where, we kind of all see ourselves fighting a bigger battle of financial illiteracy and the world's money problems. And so it's more easy for us to, not be competitive with each other, but just kind of work hand in hand on things.
Where do you think someone could go that's listening to this that wants to get more information on personal finance? It's probably new to maybe blogging or bloggers or other financial podcasts. What's a good resource where someone can go to get more information on personal finance? And then I'll flip the question where now you're starting another podcast really to help podcasters, I think, in get a little bit better on the media side.
Yep. Yeah. Certainly, Rockstar Finance is sort of a aggregator of a lot of the best personal finance blogs, podcasts, books, and shows out there. If you're into YouTube and you want to follow someone on YouTube, we have a listing over at FinCon. If you just search for personal finance YouTubers, you'll find that list. And so those are some good places to start. Of course, my site, I've got actually a map of all the personal finance bloggers on my blog, and so you can kind of see where across the country different perspectives and different sites. We also have a list of some of the top podcasts out there on the show, and then of course you mentioned the Money and Media podcast that we do for leading up to the event. And so on a weekly basis, we reach into this archive of speakers and folks who contribute to our event at FinCon and interview them on specific subjects, whether it be podcasting, blogging or vlogging, and really deep dive with them about how they're kind of creating their craft. And oftentimes folks turn to that show to get their podcast going or kind of get going with this craft.
We're talking to Philip Taylor, a.k.a. PT from PT Money. Hey, I know you're a busy guy. I really appreciate the time that you spent with me. Any parting final words of wisdom for our listeners?
Pay yourself first. Do it automatically if you can. And once you get tired of consuming, start creating.
There you go. There's PT, folks.
Hey, have you noticed many of the folks who share their paths to financial independence on Your Money, Your Wealth tell us about researching, learning, reading, and understanding the road ahead of them before and during their journey. Whether your goal is financial independence or a secure retirement, having a strategy to make your money last is key. Southern California, learn financial strategies for turbulent times at our free monthly Lunch and Learn events in San Diego, or sign up for our retirement classes in San Diego, Orange County, and Los Angeles. Visit the Learning Center at yourmoneyyourwealth.com to reserve your spot at one of our live events. Get the tools and confidence you need to make your money last. Sign up in the Learning Center at yourmoneyyourwealth.com. Time now for Big Al's List. Every week, Big Al Clopine scours the media to find the best tips, do's and don'ts, mistakes, myths, and advice to improve your overall financial picture in handy bullet point format. This week, 5 ways to turn retirement savings into income.
So this is for folks that have saved and they've got money in their IRA, maybe money in their Roth IRA, maybe money in their non-retirement accounts, non-qual accounts. And it's like, all right, now what? How do we go about coming up with an income distribution plan? Right? Because in a lot of cases, think about a generation or two ago, Joe, it's most jobs had pensions. And then there was Social Security, you had pensions, Social Security, and you didn't really have to worry much about this. Nowadays, there's so few pensions relative to the past. The government employees still have them. But now it's a matter of saving your own money, and then when you turn 65 or whenever you retire, how do you go about distributing that money? So here's 5 different methods.
Okay.
First one, you've heard this a million times, the 4% safe withdrawal rate. Okay? So this says that, and this is a traditional approach, that you can safely withdraw about 4% of the initial value of your retirement savings and increase that amount each year with inflation. So just a real simple example, you got $100,000, 4% of that is $4,000. Next, and you earned 6%. So you saved 2%, so now you got $102,000. So now the next year you get to take 4% of $102,000, which is $4,080, if I'm not mistaken.
I love Bill Bengen.
Yeah, and that's who came up with it in the early 90s.
But I don't think that works at all on a distribution plan. I think it's a really good tool to use to see if you are close in regards to what your nest egg should be.
In other words, before you retire, apply that test.
Apply the test before you retire.
How close am I?
Right.
So what are the cons with that strategy?
Well, a sequence of return risk will kill you.
Yeah. What if the market crashes?
Right. And then but people will get, so it's like my $100,000 just went down to $70,000. Am I still going to pull 4% out of the 70? That's what the rule implies. You're going to have to take a significant haircut, but people will not do that because they're comfortable or they have bills to pay. They have certain things that they have to do. And so if they are accustomed to pulling X amount of dollars out of their account, they're going to continue to pull that same amount of money out of their accounts, even though their portfolio is going down because they're not looking at where they should be pulling the money.
Right.
Are they selling stocks? Are they selling bonds? Do they have enough cash? What is their rebalance strategy as they're pulling dollars out? What's the tax strategy? So I guess my point is that the 4% rule to say, hey, if I want to spend $50,000 a year, 4%, $50,000, what, $1 million bucks, a little bit more than that, 2 million, 1.25.
Right. Yeah.
So that will tell you if you're close, because if you're spending $50,000 and you have maybe $400,000, even though 400 is a big number, but 50,000 will eat that up very, very quickly.
Yeah.
So you want to do just simple arithmetic just to see, all right, well, what does that number need to be close to?
Yeah. So in other words, am I in the ballpark?
Right.
Because like if you have $100,000 and you want to spend $40,000 a year, it's like
a couple of years. You're done.
Right. Exactly. So I agree with you. Now here's another one. The 7% optimal withdrawal rate. This is Wade Pfau, and he's the one that said the 4% was too high. But he came up with the 7%.
Because he's probably using, a guaranteed income annuity or something?
Well, no, actually.
Reverse mortgage?
It's kind of interesting. I'm not sure I've seen this one before. He's argued that some retirees may be willing to take a larger risk of depleting their savings for more income early. In other words, enjoy it while you can.
Right.
So he proposes a 7% initial withdrawal rate as a more optimal balance between competing demands of higher income and preserving income. But then, of course, you got to tail it off and spend a lot less.
Yeah, because you're out of money.
That's right. And
so you're just going to live off of Social Security.
But even he agrees. He says it may not be safe because his calculations say there's a 57% chance over 30 years you'll fail, more than half.
Right.
So he's not saying it's the best approach, but you get the thinking, because a lot of people have that same question with us. It's I want to spend more now while I can travel and less later, and there's some justification for
Absolutely.
that. But the problem with any of these is life changes, you really need to be monitoring this all the way through instead of just this hard and fast rule.
I wish there was a magic bullet that you could do that.
Right.
Because that would be ideal. It's like, all right, well, let me pull 7% out
Right.
for the next 15 years,
Yeah.
and then I'll only pull 3% out because I'll be frail.
Right.
But who knows what the market's going to do during those periods of time when you're pulling 7% out?
Right. Yeah.
Blow
that's
you
right.
up.
That's right. Here's another one, Joe. This is kind of a traditional, old-fashioned one. Living off investment income.
Oh, just what? Interest and dividends?
Yeah. Interest and dividends.
Yeah, that will.
The problem with that is what? There aren't any.
Right. That's how much
I
you
mean,
want to
the
make.
Treasury notes paying 2%,
Yeah.
not under 3% anyway. And if you're wanting to live on 4, 5, 6, 7%, as we just went over, it's you're going to have a lesser lifestyle.
Well, the problem is that if you go back 30 years ago, now the retirees, they're using rules that maybe their mother and father used.
Right.
Right? Hey,
Yeah.
well, we got GE stock. It's a great dividend-paying stock. We're going to live off the dividends. We're going to buy some bonds and get a 6% coupon, and we're
Yeah,
never going
right.
to touch the principal. Oh, if you touch the principal.
Yeah, that's bad.
Yeah, oh, that's bad.
Yeah. Yeah.
Right? Well, we don't live in that time anymore.
No, we
It's a time warp. You got to figure out, okay, well, what are you trying to accomplish with the money that you have? How much are you trying to distribute to yourself in form of income? But that's why these high dividend paying stock, ETFs, mutual funds, or strategies are just overinflated
Right.
because it sounds great. Who
Yeah.
doesn't want high dividends?
Right.
I do.
Yeah, of course. Yeah. Anyway, and we get that question all the time, and we live in a different world. I think total return is a better approach. Now, here's another one, Joe. This is kind of cool. This is spend safely in retirement. That's
Yes.
the plan.
Well, I think
And
Captain
just-
Obvious.
So that's all you got to do. So Stanford Center for Longevity and the Society of Actuaries, those smart people,
Very
they
smart.
studied 292 different retirement strategies and came up with their ideal plan, which consists
There's
of
292 retirement income strategies.
that's what they looked at, 292 different retirement strategies.
Well, that would be a great show. Let's go over all 292.
We may have to devote a month to that. We'll get right on it. So so here's what they say. It's not a bad idea, actually. I mean, absent of any other real planning, is delaying Social Security benefits to age 70.
Okay, I like that.
Withdrawing 3.5% of your nest egg from age 65 to 70, and then using the IRS required minimum distribution tables to determine withdrawals for all your retirement accounts starting at age 70. So it's an increasing amount.
These are the smartest minds in the world came up with this.
292 retirement strategies.
And
This
that's
is
the
the
best
best one. Yeah.
Push out Social Security at age 70. How about if I retire at 65?
Well, that's okay. You withdraw 3.5%. If you retire at 60, it doesn't say.
Got it.
Yeah. Or
Push
50,
it out to 70.
55.
They just only take 3.5% out.
Yeah.
And then only take your RMD.
Yeah.
Yeah, perfect.
It's actually, I mean, it's not a bad idea.
Is that your plan now?
That's it. I'm 60 years old. I got to work 5 more years, and I've got the best plan, according to the Stanford Center for Longevity and Society of Actuaries.
Well, I thought after your little rock and roll cruise, you'd push your retirement a little earlier.
I'm not going to do that. I'm just going to take more vacation.
Because you don't need enough.
I need to, I only get 4 weeks. That's
You took 2
barely.
vacations in 3 weeks.
I know. It's just the
That
way it
week
happened.
back from the office was just too much for you.
Yeah, and now I'm not leaving until June, so I'm really in trouble.
If you're mentally ready to ditch the job, taking 2 vacations every 3 weeks like Big Al, make sure you're financially ready for retirement too. Learn more about creating retirement income, as well as how to control your taxes in retirement and how to protect yourself against market volatility, increased longevity, rising healthcare costs, and Social Security uncertainty in retirement. Visit the white papers section of the Learning Center at yourmoneyyourwealth.com and download our free retirement readiness guide. You'll learn strategies that'll make your money last a lifetime, and it won't cost you a thing. Download the Retirement Readiness Guide from the White Papers section of the Learning Center at yourmoneyyourwealth.com. Now, if you need more help in preparing for your retirement, call us at 888-994-6257 or email info@purefinancial.com. That's 888-994-6257 or email info@purefinancial.com.
This was not to us. This was to Kiplinger's Personal Finance.
Okay.
I thought it was kind of an interesting question.
You could have just said it was to us.
I could have. If I win the Powerball jackpot,
Yeah.
will that affect my Social Security benefits? I'm 63, so I'm worried about the earnings test.
Well, earnings. So fun.
That was a
This
fun
guy's
question.
just dreaming. What the heck is
I
this
mean,
all
it's a
about?
1 in a billion chance, so don't lose much sleep.
Here, my
over it.
retirement plan is the Powerball weekly.
It's gonna mess up my Social Security.
So, I save $100 a week, but it's to the Powerball. It's not to my retirement account because I'm going to win. No, the earnings test is based on earned income.
Earned income.
Earned
so that's
income.
like salary.
Yes, you have to.
Not Powerball winnings.
Not Powerball winnings. Powerball
So-
winnings would not affect your.
So in other words, you could win the Powerball.
Yes.
And still get your full Social Security.
Well, no. Yeah, yes. If he took it early. So what
took
he's
it early.
referring to is that if you take your benefit prior to full retirement age, right, and you cannot have more than about $18,000. I'm rounding.
Yeah, it's about
About $17,800.
Yeah. Uh-huh.
If you make more than that as earned income, then every $2 that you earned, they take $1 back. It's not really they're taking $1 back. What they're doing is that they're assuming that you're not taking it for that month, and then your benefit would increase when you do stop working, right? So if you claim it early and you still have wages higher than $18,000, then every $2 that you earned over that $18,000 limit, they'll take $1 back from your Social Security benefit.
Right.
But that's earned income now. So that's wages, that's self-employment income. So when you look at Powerball winnings,
Yeah, it does.
that would affect the taxation of your Social Security benefit.
Oh, sure. Right.
Because you'll probably receive interest and dividends from that Powerball winnings.
Yeah,
and then that
not to
should
mention-
put you
not
over.
to mention the winnings themselves are taxable.
Right.
But so Joe, the number, I looked it up, 17,040. So just over 17,000 is our number.
That 17,040. Mm-hmm. Well, look at the fact check on Big Al.
I got the little cheat sheet right in front of me. Anyway, I think it's a kind of an interesting question that you would be worried about collecting your Social Security benefits when you got the Powerball winnings.
Well, that's the world we live in.
So, and I hope this individual.
I hope he wins it.
I hope he or she is not losing sleep because it's not going to happen. I'll tell you that.
Well, you ever seen that show? Like those Powerball winners?
Yeah.
And how fast they blow through millions?
Yeah, and the stats are whether it's Powerball or any lottery, within 5 years they're bankrupt. I mean, the majority. It's crazy. It's because when it's not your own money, it doesn't feel the same.
Right. Let's buy 14 four-wheelers and buy a ranch. Oh.
Yeah, have you ever been to your ranch? No, but I hear it's great.
Yeah, I have 4,000 acres. Yeah, so I can drive my four-wheeler around in it.
Have you ever actually driven the four-wheeler? Nope, don't know how to.
Yeah, don't know how to do it yet.
Don't know, and I don't know how to kick it into gear.
But Social Security. Well, he's claiming it at 62. Maybe he's taking all his earnings
I think that's
from
what he's
Social
doing.
Security, and he's
And
just
putting it in the
parlaying
Powerball.
Why not? That's
So-
called leverage.
Because he doesn't want to lose that up because you want to keep parlaying that into more Powerballs.
You have to. Alrighty, that's it for us today. Thanks for listening. For Big Al Clopine, I'm Joe Anderson. Show's called Your Money, Your Wealth. We'll see you next time.
So to recap today's show, Bitcoin and other cryptocurrencies, they're taxed just like stocks are. So take that into account when dollar cost averaging into crypto or using digital currencies to buy that sweet, sweet parka. There are at least 292 retirement income strategies, and the best one for you may not be one of them. It all depends on your specific financial situation. For help figuring it all out, contact Joe and Big Al at info@purefinancial.com. And please, whatever you do, don't bet your retirement on the Powerball. It'll probably screw up more than just your Social Security. Special thanks to our guest, Philip Taylor. Learn more from PT on becoming financially independent at ptmoney.com. Subscribe to the podcast at yourmoneyyourwealth.com, your favorite podcatcher, or Apple Podcasts. And hey, thanks for putting us in the top 200 investing podcasts on iTunes. It was only for about 5 minutes, but hey, that counts for something. Listen next time for more Your Money, Your Wealth, presented by by Pure Financial Advisors. For your free financial assessment, visit purefinancial.com. Pure Financial Advisors is a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full and informed investment decision.